Activity on the fixed income market yesterday bounced some 138% to 2 billion shillings. And this in stark contrast to what we're seeing on the equity front, only around 132 million worth of equities being traded. Local investors still appear to be dominating activity. What is your reading of the equity market at this point?
I think, as you said, local investors have been key sellers of stocks, particularly with the focus on Safaricom and the banks, Equity Bank and KCB, as well as Barclays Bank. This whole week, they've been trading out of the equities market and switching into the money markets. And given from the auctions that came in last week, the 91-day T-bill is doing over 16%. So for them, in the short term, they much prefer to be invested in the money market as opposed to being invested in the Nairobi Stock Exchange for now.
Looking at some economic data that we saw out yesterday, headline inflation touching almost 20%, sitting at 19.72% in November. That's from 18.9% in October. What's driving this upward pressure in inflation?
The appreciation on the inflation has been mainly driven by transport costs. Last month, the ERC increased fuel costs by about 3% across board. So this has definitely been felt on a month-to-month basis. Non-food items such as communication and as well as transportation have also been pushing up the inflation rates. But for once this month between November and October, the food prices were actually much lower than they were last year, and we began to see the impact of the long rains that came in March having a positive impact on the food prices. And I think the short rains that are going on will definitely have a continued positive impact through to first quarter in 2012.
So you say a positive impact there on the food side of things. The MPC has now set their inflation target at 9% for 2012. Do you think this is achievable given the fact that we're sitting at almost 20% at this point in time?
Our economists beg to differ. They have higher rates north of 10% for next year in terms of inflation.
In the banking sector, we saw those stocks trading into the red. This as it was announced that banks are now extending loan repayment periods for some customers by up to 6%, given the fact that they're concerned about the risk of default. And this at the same time as we're going into December, traditionally a high spending period. So of course the MPC is going to have to weigh up these two factors when they make their decision on rates tomorrow. Are you expecting a dovish or a hawkish stance from Nguni?
Actually, we expect the MPC to hold its CBR rate at where it is right now. But I think some of the locals think that there'll be a bit of a spike, maybe 100 basis points based on the inflation numbers that came out in November. But as a house, we expect the rate to remain stable tomorrow.
So a stable rate is sitting at 16.5%. Let's move on to some of the stocks that we saw moving yesterday. KenGen really being sold off by local investors, it seems, touching a low of around 8 shillings 15, has recovered somewhat at this point in time, but still one of the stocks that we see really being punished in the market, down some 50% this year. Is there any case for investing in KenGen in this economic climate?
I think if you're going defensive on the Nairobi Stock Exchange, you'd either be looking for high dividend yielding stocks, which KenGen doesn't fall in that category, or you'll be looking for a defensive stock where people actually have to spend and consume the products of that company. And on the utility segment, it would be more of KPLC as opposed to KenGen. KenGen is generating the electricity, so they have to either depend on thermal, they're going into geothermal, and they've also been dependent on hydro. The hydro dependence has not been consistent as we've been seeing increased power outages over the year. If you're playing the utilities, you're actually better placed playing KPLC because they transmit electricity and charge the end consumer and are able to pass on any fuel surcharges to the end consumer. And I think on both names, then what would be penalized would be KenGen because it's on the generating side of business and it doesn't actually have a place of passing on cost in the medium term because its pricing is actually predetermined by the government.
Moving out of Kenya's borders, about 100% of the activity last week on the Rwanda Stock Exchange came from Bank of Kigali. It only listed on the exchange this year, reported Q3 numbers. Just looking at the 9-month performance there, you've got net earnings sitting at 5.8 billion Rwandese francs. What caused this kind of 43% growth in earnings so far this year?
There's a lot of growth in their non-funded income, transaction income, forex income coming through the year. This grew by 61% from last year where it was. So this was definitely a key contributor for them. However, on their funded income, net interest margins were very low at 7.6% for the year, which meant that they didn't actually have robust growth on that line. At 5.8, yes, it's definitely strong numbers, 43% year-on-year growth, but as a house, we have them doing 8.9 billion at the end of the year, which at this point doesn't seem like a number that they'll be able to achieve. Based on this, we have a hold rating on this company at a pricing of 136 Rwandese francs compared to the current trading price of 131.
So likely to miss your earnings target for the year, but if you would like to get exposure to the Rwandan economy, is this a good stock to enter through?
I think if you wanted to look at the Rwandan economy, you'd probably be better placed looking at Bralirwa. Fast-moving consumer goods. There's a lot of consumption of alcohol going on in the interim, as opposed to Bank of Kigali, which at the current price offers much less upside. I think for Bank of Kigali, they've just raised new capital. They're trying to extend their loans, and they're being very aggressive in their loans, but they're not able to mobilize deposits as fast. So that is not going to be a positive for them, at least for this year and next year. And on ROEs, they'll be delivering an ROE of less than 20% for this year. On valuation, the bank is at 1.2 times book compared to 1.3 times book for Kenyan banks. If I was looking at banks, I'd probably be looking at Kenyan banks. But if I was looking at the Rwandan economy, I'd be looking more at Bralirwa.